What about just in terms of the current climate, the idea that because we now all of a sudden have a lot of safe liquid yield in the world when we didn't have it before, that it's not as necessary to stretch into private markets to grab those returns? Obviously the returns will be higher, but the idea that you can sort of sit back and sort of keep it simple with 6% plus yields in investment grade debt or something like that.
This may be counterintuitive, but Ares manages $400 billion in assets, $300 billion of which is credit. But every alternative asset class, the way to think about investor behavior is trying to generate excess return relative to whatever the liquid market equivalent is. Mm-hmm. So if you're investing in private equity, you're trying to generate excess return relative to the public equity markets. If you're investing in private credit, you're trying to generate excess return relative to the leveraged loan market, so on and so forth. Viewed through that lens, as long as the private market asset classes continue to generate premium return relative to the actual risk or the perceived risk, people will buy it. Mm. So what we're experiencing now, which I think is the proof is in the pudding, private credit, interest in private credit and private credit fundraising is actually accelerating even as rates have been rising because of that durable excess return. And if you're an institutional investor that has an actuarial target, 6, 7, 8%, and you can now generate 11 where you were generating 6, you're not going to say, I don't want the extra return. So there are a few structures where you may have a set of liabilities where you don't have to chase the premium.
Yeah, I've seen some work that says you have, defined benefit pensions are overfunded to a point where they might just...
You may see in certain corners, but that's probably the exception, not the rule.
Got it.
Yeah, and to that I would add, I think obviously treasuries are yielding more than they've had in quite a long time. I don't think it's a bad investment. I think they're good investments. But the excess return in private credit is quite interesting. But in comparison to publicly traded credit markets of equivalent ratings or equivalent risk, I think private credit is more attractive both on a risk basis and a return basis. Now, specifically on the risks, if you looked at older vintage broadly syndicated loans, which are floating rate as well, and also in large part funded in connection with LBOs, those capital structures were put in place at a time when base rates were at 25 basis points. Today they're over 5%. Some number, some tail of those issuers will experience stress or distress. And therefore, just buying the market is probably more risky than it would appear currently, given the absolute return or the yield that is available on broadly syndicated loans at the moment. Mm-hmm. Whereas in private credit, even in an older vintage portfolio, you really have a little bit more control. You have more of a relationship with the borrower. You're able to negotiate through a down cycle. But I do expect, and I would expect, that in broadly syndicated loans, you are going to see elevated stress and default levels. And with the deterioration in the legal protections in those documents over the last 10 years, I think you will see quite unexpected outcomes. Lender-on-lender violence, the ability for opportunistic lenders to come in over the top of what was once considered a first lien and priority loan. So there are embedded risks that I think will begin to unfold over the next year or two as there is stress in the economy and stress in the markets with elevated rates for a longer period. So it isn't a free lunch. I think I'm concerned right now in the market that everything looks quite healthy and quite good, but feels like a little bit of a head fake to me, and that the economy and the markets could actually experience some trouble going forward. I would be a little bit careful about how you dimensionalize the return on publicly traded debt especially, because some portion of that should be viewed as a return of capital rather than a return on it. Whereas in private credit, I think some of that is also true, but you have more of the control in your hands as a lender to really be the captain of your own fate.